Hey everybody, Chris Lamm here. This is our market update for the month of April. Hope everyone's doing well. Well, we have a lot to talk about right now. For many of you know this, mortgage rates have been on the rise. Since the first of the year, mortgage rates were in the threes, and in the last few weeks, we've seen them go over 5% a couple times. This comes as a shock to a lot of people that are buying homes, and it's understandable. Now, as we look forward through the rest of the year, through the summer, which is traditionally one of the busiest times where sellers bring homes to the market, buyers go out to find their dream home, a lot of people are concerned and wondering what the future holds. And we just wanted to take some time and explain a couple details and some facts that we're watching right now that may help you make a better decision. So the first thing we want to talk about is, why are mortgage rates where they're at? Now, if you remember correctly, the Federal Reserve raised the federal rate in the month of March for the first time since 2018. Not only did they do that, but they basically stopped some of their stimulus programs, commonly referred to as quantitative easing, where they were purchasing assets to artificially keep rates low. They also started selling some of their assets back into the market, and this has become as a shock to the financial markets, which is why we've seen so much volatility in mortgage rates over the last few months. Now, the big question is right now is, how does it look for affordability? Now, I'm not going to lie to you, rates going from 3% to 5% is going to impact your mortgage payment. However, for most people in Shasta County, in Northern California, it's about a $100 difference when it comes to a 30-year fixed mortgage. I don't know about you guys, but last time I went to Chick-fil-A with my family or any restaurant in town, it was almost $100. So for most people, they're going to be able to afford their payment with rates where they're at today. The other thing we want to talk about is where rates are going in the future. Now, it was just a few months ago that we were being told rates would be in the mid fours. Here we are, April, the beginning of April, and they're actually scratching 5%. There are some experts that are predicting we could see rates in the sixes or even sevens by the end of the year. And the reason for that is the Federal Reserve and our current administration is very concerned that they've created a pretty bad situation, to be honest with you, with inflation. And that this inflation that everyone's experiencing at the gas pump, at the grocery store, with their energy expenses is going to get out of control. And for many, it might already be at that point. What they want to do is they want to act quickly and try to get this inflation under control, which could create some temporary pain when people go to talk to their mortgage person and they're shocked that the rates are higher. Now, here's the good news. Right now, when someone's looking to purchase a house and they compare buying a house at the median sales price in Shasta County to renting that same house, they're still going to pay less than what it costs to rent over the course of a few years, because rents are going up very quickly. And most homes right now in Shasta County, they're going to raise rent at 5% a year every year for the next several years because of rent control. So it still makes sense to buy for most people if their other alternative is renting a home. The second thing is, if you look back throughout the last 30 to 40 years, anytime we see rates rise, it's usually followed by a time where rates drop again. And so when getting pre-qualified, when looking at buying a house right now, you might be locking in at a rate that you wish was lower, and your mortgage professional might suggest paying points or even looking at adjustable rate mortgages. Those could be good options. However, most experts right now are predicting that we will see low rates again, most likely in the next year, up to 3 years. Rates will most likely drop again due to possibly a recessionary event. So there's cycles over the last few years. Rates go up, rates go down, and a lot of people right now, we're advising them to not pay points and to lock in at a rate where we can get them into the house and to look forward to that opportunity to possibly refinance at a later time. So the last thing we want to talk about is home prices. The question for the last year has been, home values are at all-time highs. Is the housing market going to crash? And the answer to that is nobody knows, but the odds are very, very unlikely that we're going to see housing crash. We may not even see home prices go down by much because of the demand and the lack of supply. Now, I've shared this before, but we're just going to talk about it again because it's very topical right now. Nationwide right now, we're short 10 million homes for the demand that we need. And with the rise in population and families that are getting through college and having kids and needing a home, we are just way too far behind on the units needed to replace those homes. if we continue to see inflation, we may see builders pull back because of the cost of supplies. And if builders stop building, it's only going to make that problem worse. And so for most people right now that are concerned about the value of their home they just purchased, or if you're thinking about buying a house and you're worried that you're going to buy at the top and your home is going to be worth less at some point in the future, that could happen, but it's very, very unlikely right now. And the last thing we're going to talk about, the last thing, is there's a lot of people talking about a recession. I'm not an economist, but I study these things all the time. And one of the things that I'm going to do here is I'm going to bring up a graph for you. And I want to show you that every time we've had a recession over the last 20 years, you'll notice that home values have actually been stable and have even gone up, with the exception of the last housing bubble we had in 2008 and 9. Now, let's face it, that was a very different time. Those weren't the most quality mortgages back then. People had 580 credit scores. They were financing 100% financing. They were getting into adjustable rate mortgages where their payments were double, tripling, quadrupling on them. But with the exception of the Great Recession, every recession we've had, real estate has remained strong and has in many cases gotten stronger shortly after the recession concluded. And so when we look forward, no one knows what's going to happen. Anyone that tells you they do, I wouldn't listen to them. But these are some facts that we're talking to our clients about. Hopefully they're helpful for you. If you have any questions about housing, real estate, mortgage, or anything else, I hope you know I'm always available to you. Hope you and your family are doing well. Have a great day.